You hear the name Warren Buffett and you think investing genius, right? But what if his secret sauce isn't some crazy complex formula? What if it's something simpler? Today, we're going to unpack the Oracle's timeless code. We'll break down his core principles into a framework that you can actually understand and, more importantly, use. Let's dive in. So let's just start with this bombshell of a quote.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality.
Buffett's very first rule, it has nothing to do with spreadsheets or algorithms. It's all about psychology. He's basically saying, look, you don't have to be a genius. What you do need is the ability to keep your head on straight when everyone else is losing theirs to fear or greed. All right, so how do we actually do that? We're going to break it down into 3 key pillars. First, getting the mindset right, then figuring out the right price, and finally, taking the right actions. And we'll wrap it all up with a really cool mental model he calls the 20-slot punch card. Okay, let's jump into pillar number 1, the right mindset. Before you even think about looking at a stock or a company's financials, you've got to get this part right. It's the foundation for everything, and I mean everything that follows. So what's the most important part of that mindset? Humility. Yeah, you heard me.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, I'm no genius, he said, but I'm smart in spots, and I stay around those spots. And, that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, the stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should.
And this is a perfect example, straight from the man himself. He gets a business like Wrigley's Chewing Gum. Why? Because it's predictable. He can look out 10 years and have a pretty good idea of what that business will look like. But what about picking the next big tech winner? He's the first to admit it. I have no idea. And that's not a weakness, you see. That's his superpower. He just stays away from it. Okay, so once you know your circle, you need another key ingredient. You've got to be able to think for yourself. The market? It's basically a giant, moody crowd. Getting 1,000 people to agree with you means absolutely nothing. You're right only when your facts and your logic are solid, even if you're the only one in the world who sees it that way. And this is where that temperament thing really kicks in. It's your secret weapon. Buffett calls market swings convulsions, which is such a great word for it, right? These fits of panic and euphoria. And while most people are getting tossed around in that emotional storm, the smart investor is just standing there, calm, rational, and ready to pounce on the opportunities everyone else is too scared to see. So here's the ultimate litmus test for your mindset. I want you to try this. Next time you think about buying a stock, ask yourself this one simple question. Would I be okay with this if the stock market closed down for 5 years starting tomorrow? If your gut reaction is no way, then you're not investing, you're just gambling on the price. But if the answer is, yeah, absolutely, well, now you're thinking like a business owner. All right, so you've got the mindset down. Now we can talk about the numbers. Welcome to Pillar 2, the right price. This is where we get into the analysis. And the goal here is actually pretty straightforward. Find out what a company is really worth, and then, and this is the important part, pay less. Now, early on, Buffett had this strategy he called the cigar butt approach.
And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake.
So he had a major change of heart. And why? Because he realized something profound about time. Time is the absolute enemy of a crummy business, but it's the best friend a wonderful business could ever have. A great company just gets more and more valuable over the years. And that led to one of his most famous lines.
I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
Okay, but how do you figure out what a fair price even is? It all comes down to this core idea, intrinsic value. Just forget the stock price you see on the screen for a minute. The real value is all the cash a business is going to spit out between now and, as he says, Judgment Day. Your job as an investor is to get a rough idea of what that number is. And leave it to Buffett to explain this with a proverb that's literally thousands of years old.
Because here Aesop was in 600 BC. Smart man, wasn't smart enough to know it was 600 BC, though. I mean, would take a little foresight. But Aesop, you know, in between tortoises and hares and all these other things, he found time to write about, you know, birds. And he said, a bird in the hand is worth two in the bush. Now, that isn't quite complete, because the question is, how sure are you that there are two in the bush? And how long do you have to wait to get them out? Now, he probably knew that, but he just didn't have time because he had all these other proverbs to write and had to get on with it. But he was halfway there in 600 BC. That's all there is to investing, is how many birds are in the bush, when are you going to get them out, and how sure are you? Now, if interest rates are 15%, roughly, you've got to get two birds out of the bush in 5 years to equal the bird in the hand. But if interest rates are 3%, and you can get two birds out in 20 years, it still makes sense to give up the bird in the hand, because it all gets back to discounting against an interest rate. Problem is, often you don't know, not only how many birds are in the bush, but in the case of the internet companies, there weren't any birds in the bush. But
It's so simple, right? Those two birds in the bush, that's the future cash, the intrinsic value. And your whole job is to figure out, okay, how many birds are actually in that bush? When are they going to come out? And how sure am I? That's investing, right there. And all of this brings us to probably his most famous rule of all.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean,
Now, that sounds simple, but what he's really talking about is one thing: margin of safety. The whole reason you calculate what a business is worth is so you can buy it for a lot less. That gap, that discount, that's your safety net. Because at the end of the day, this isn't just a spreadsheet formula. It's a philosophy of survival. You're building in layers of protection, like an airbag, so that when you're wrong, and let's be honest, you're gonna be wrong sometimes, no single mistake can wipe you out. It's about making sure you live to play another day. Okay, mindset? Check. Price? Check. So what do you actually do? That brings us to pillar 3, the right actions. This is all about how you behave in the real world when the markets are open and things are moving. First things first, you have to get your relationship with the market right. Think of the market as this moody business partner, Mr. Market. He's not there to tell you what to do. He's there to serve you. Most days, he's just babbling and you should just ignore him. But every once in a while, he gets super emotional and does something completely silly. And that's your moment. That's your opportunity. And Buffett doesn't mince words here.
in the market, if you think the market knows more about what your business is, in other words, if your stock goes down 10% and that upsets you, it obviously means that you think the market knows more about the company than you do. And in that case, you're the patsy. If it goes down 10% and you want to buy more because you know the business is worth just as much as when you bought it before, or perhaps a little bit more with the passage of time, so you buy more, they're the patsy.
He basically says, if you've done your homework, you know the business, you bought it at a good price, and then the stock drops 10%, you should be thrilled. It's on sale. If you get upset instead, that's a huge red flag. It means you trust the market's crazy mood swings more than your own research. And in that case, as he puts it, you're the patsy. Next up, you have to constantly think about opportunity cost.
I would argue that one filter that's useful in investing is the simple idea of opportunity cost. If you have one opportunity that you already have available in large quantity, and you like it better than 98% of the other things you see, well, you can just screen out the other 98% because you already know something better. So that people who have a lot of opportunities tend to make better investments than people that don't have a lot of opportunities, and people who have very good opportunities, and using a concept of opportunity cost, they can make better decisions about what to buy.
Every dollar you put into one thing is a dollar you can't put somewhere else. So any new idea that comes along has to compete with the best idea you already hold. Just using that one little filter will make you say no to 98% of things, and naturally will lead you to a portfolio of just your absolute best, highest conviction ideas. And the last action, you have to learn to ignore the noise. Turn on the TV, and it's all chatter about interest rates, GDP, the next recession, and what does Buffett say about all that?
Charlie and I, to my memory, in 53 years, I don't think we've ever had a discussion about buying a stock or a business or selling a stock or a business that has been where we've talked about macro affairs. I mean, if we find a business that we think we understand and we like the price at which it's being offered, we buy it. And it doesn't make any difference what the headlines are. It doesn't make any difference what the Federal Reserve is doing. It doesn't make any difference what's going on in Europe. We buy it. You know, there's always going to be good and bad news out there, and which gets emphasized the most depends on the moods of people or newspaper editors or whomever. And there's a ton of bad.
Focus laser-like on what you can know. Is this a good business? Do I understand it? Is the price right? So we've covered mindset, price, and actions. Now I want to leave you with one final, powerful idea that pulls all of this together. It's a mental model that just forces you to be disciplined, to stay in your circle, and demand that margin of safety. He calls it the 20-slot punch card.
You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision, and you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Now, how would that change the way you act? You'd stop dabbling, right? You wouldn't buy some hot stock because your buddy mentioned it? No way. You'd think so hard about every single punch. You'd sit back and wait patiently for that perfect opportunity, what a baseball player would call a fat pitch. And when it finally came right over the plate, you'd swing big. You'd make way fewer decisions, but man, they would be high quality. And that's really the final thought here. It's such a powerful idea, and it goes way beyond just stocks. Think about your career, your big life choices. What if you only had 20 of those? So the question I want to leave you with is this. If you had to treat every big decision like it was one of only 20 punches you'd ever get, what would you do differently? Starting right now.